Hi there eToro, it is Monday the 17th of October and that means it's time to take a look at what moved the markets last week. Before we begin, this video is going to be quite short because I give my quarterly Copier update on Wednesday of this week and it takes a hell of a lot of preparation. I need as much time as possible. I will share the link of the recording to that video once I get my hands on it. Alright, starting from the usual place, well, it's been another week in this very long bear market, and we can see that the decline continued within the NSDQ100, the SP500, and that we actually took out the lows set in June within each of these indices. On screen I also have the US government 2-year yields, so the yield on the 2-year bond within the US, and I'll talk about why in a moment. And then on the bottom right, we're seeing some action within the Chinese market, so there's been a bit of a rally. My guess is that it's been a rally into the Communist Party Congress event, which kicked off on Sunday of last week. The yield on that particular bond is telling us where it thinks that the Fed funds rate is going to end up within a 2-year kind of time span, within a relatively short amount of time. So what we can see at the moment is that the Fed funds rate is roughly 2.5%, and so the market thinks that the interest rate in the US is going to go up by roughly about 2% within that same time frame. Now the reason that the yield over here jumped quite a lot last week and stocks sold off quite a lot in the US at least is because the annual inflation rate within the US came in a little hotter than expected. Now because we were short on time this week, I'm not going to go through all the various different measures of inflation and what makes up this particular basket and what's risen by the most. For now, I think it's enough to note that the trend for inflation within the US seems to be down. So you can see that this is the lowest figure within the past 7 months of the inflation number being reported. This is an annual figure, by the way. But the reason that the market was unhappy with this, even though it's showing a downtrend, is that the number came in hotter than expected. So you can see that the expectation was that it would come in at 8.1%, instead it came in at 8.2%, and the core inflation figures were also a little bit ugly. And that's at the expectation that the Fed is really going to go at it when it hikes rates at its next 2 meetings. And this is what has caused the yield on the 2-year Treasury to pop within a very short amount of time. And the stock market has repriced equities in a similar way based on that increase, that expected increase in the interest rate within the US. Now this has been a very, very painful bear market. Here on screen I have a few indexes as well as ETFs that I like to follow, and you can see that the year-to-date figure, for example, for the NSDQ100, a massive index with very healthy, usually big companies, is down nearly 35% for the year, excluding today. I know that the markets have jumped quite a lot today. And this is very painful, obviously. It's quite frustrating. It wears on you psychologically. There are a lot of people out there that are passive investors. Any money that they invest, they tend to invest in indices such as the NSDQ100 or the SP500. And if they haven't been through this kind of market turmoil before, I'm sure many of them are wondering if this is it, if this is the end for them. But the truth is, even though it's quite rare to see these major indices down so much, it does happen. They rise and they fall, and that's just a part of life when it comes to investing. Other major events that happened through last week, well, the GDP number for the UK came in lower than what was forecast, and this has actually been counter trend. So you can see that the last few times that it has been reported, it actually came in quite a lot stronger than the market was expecting. This is by no means affected by the mini budget that was announced just a few weeks ago. A number of the things in that mini budget haven't even yet come into effect, and now basically the whole thing's been undone. It just shows that the economy is slowing down, and I would expect this number to get pretty close to zero and potentially go negative within the next year. I think that the UK and Europe will enter a recession probably somewhere through 2023. Of course, some of the other big news was all the hullabaloo in the UK market. So all of the issues created with the weakening of the pound, with the yield on gilts, the yield on UK bonds jumping, and that was creating havoc in a number of different sectors within the economy. It set the expectation of much larger rate hikes, which creates issues for mortgages. And the UK mortgages in the UK work slightly different from the US, and a rise in interest rate hits the mortgage market within the UK. It hits home buyers a lot harder than those in the US, because people in the US tend to buy mortgages at a rate that is fixed for a very long time, whereas in the UK there's usually a relatively short period where there's a low rate that is fixed. Long story short, the Chancellor, who hasn't been a Chancellor of the UK for very long, is now out. He's been given the boot, and we have a new Chancellor that just today has torn up just about everything that was published within that mini budget, and our government is once again the laughingstock of Europe. I mentioned a bit earlier that the Communist Party Congress has kicked off, and this is a very large event for China, probably the largest political event that happens ever. It happens once every 5 years. And in addition to setting the leadership for the country for the coming 5 years, there are also some hints with regards to the policy within China. One of the things that has been announced, and it makes me very sad to see this, is that the government is very happy with the results of the COVID-0 policy that's been in place, and it looks like they are not going to change that anytime soon. This confirmation of the stance when it comes to COVID-0 is very worrying for me, and I need to rethink how invested in China I want to be. Looking forwards to this week. So as I explained last week, we are entering earnings season, and I think that this is going to be a very, very important earnings season because the entire world is watching the forecasts that companies within the US are making to determine what the US economy is going to be like over the next 6, 12, 18 months. Markets have repriced equities within the US based on expectations around interest rates, but also a rather optimistic outlook when it comes to earnings growth within the US. So if earnings come in a lot weaker than people are expecting, I think that we could see another repricing event of equities. The longer a bear market wears on, the more investors exit the market. This is always the trend. So when times are good, more money flows into the stock market, and when times are bad, money flows out of the stock market. And actually it should be something of the other way around. When there's been a 10-year rally in the market and things are looking very expensive, just about everything is looking very, very expensive, that's a time to be concerned about future returns based on where the stock market is at that point in time. Conversely, when you've been in a bear market for a long time and equities have taken an enormous beating, that's when you should be getting very excited about what your future returns could be like relative to the point where the stock market is at that point in time. I wanted to highlight this because I know that a lot of people will be having a very tough time psychologically, but you can see that this Wells Fargo Investment Institute study says that the average 12-month return after bear market is 43.4%. That's the average return. So if you're able to pick companies that are better than average, then you would enjoy an even better return over a relatively short amount of time. Now, the challenge, of course, is that you can never know when the bottom of that bear market is in, and this is why I'm an advocate for cost averaging. I don't do it within my investment account in Etoro because it disrupts my copiers a little bit, but I do add money from time to time to take advantage of this. And outside of Etoro, I cost average into the market just about monthly. One last word on bull and bear markets is that these little valleys, these orange valleys, these are the bear markets, and these blue mountains, they are the bull markets. So bear markets can be very uncomfortable. They can be very short, sharp, and deep dives in price action. But the thing to note here is that the subsequent bull market is almost always much longer and runs much higher. So if you had cost averaged into any of these bear markets, you would have enjoyed fantastic returns no matter which point you bought in the bull market that followed that particular bear market. And for those of you that are quite analytical, you might enjoy this man's blog. He has published a book, I think, last year, and he is a big fan of cost averaging. Cost averaging is simply where you invest money on a particular schedule. You don't try to time the market. You don't care if the market is up. You don't care if the market is down. You're just buying, let's say, $100 every month for the rest of your life. The reason I say that analytical folk will like this blog is because this man looks back through historical data and he crunches the numbers on a variety of different approaches when it comes to investing. And so this particular article, which I know is a bit old now, but it still holds true, is that if you knew exactly when the dips were coming and you only bought on those dips versus someone else who just cost averaged into the market, you would do better than the person who cost averaged, but not by that much actually, and it would have been a hell of a lot more stressful. So if this is the kind of information that you enjoy, and also it'll give you a bit of a psychological boost during the bear market, I encourage you to read through it. It's a very, very interesting read. All right, that's it for this week. Until I publish my quarterly Copier update, I hope you have a good one. Speak to you soon. Goodbye.